Right, today I want to discuss about crypto historic crash and is the winter here? Okay, so on October 2025, the crypto market experienced a sudden flash crash that ranks as one of the most severe in its history. Within about 24 hours, over 19 billion in leveraged positions were liquidated, the largest one-day wipeout ever recorded in crypto. Over 1.6 million trading accounts were hit with liquidations, and roughly 87% of those positions were longs, indicating a widespread of leverage to the bullish side. Now, major cryptocurrencies plunged dramatically. Bitcoin, which has just reached an all-time high above 126,000 earlier that week, crashed over 19% down to around 102 to 104,000 at the worst point, right? Depending on the exchange that you are looking at. Ethereum similarly tumbled from just below 4,008 to under 3,005 before bouncing. In total, the global crypto market cap shed roughly 9% or about 1 trillion in value within hours. So here are the factors, that triggered the crash. Now, a confluence of factors led to this unprecedented crash. The immediate trigger was a macroeconomic shock, which was a surprise announcement by Trump threatening to impose a 100% tariff on all Chinese imports by November 1st. Now, this trade war social post hit the market on a Friday evening after traditional markets had closed, catching the crypto market in a low liquidity period. However, the tariff threat alone might not have caused such an extreme move without the fragile market conditions underneath. Leading up to the crash, bullish sentiment was running high, with the crypto fear and greed index, reaching greed levels over 60 to 70% as Bitcoin broke new highs. Okay. Now, this optimism had encouraged traders to take on large leverage long positions. When the negative news hit, these over-leveraged positions created a powder keg. Prices started falling, triggering automatic stop-loss orders and margin calls. Those forced sales drove price lower, which in turn liquidated more leverage long, snowballing into a self-reinforcing cascade of liquidations. Now, another major factor was the failure, right, of exchange infrastructure during the volatility. Several major crypto exchanges struggled to handle the surge of activity. Major exchanges reported degraded performance at the peak of the sell-off. The overall impression is that the exchange infrastructure buckled under extreme stress, adding fuel to the fire. Now, how this crash compares to previous crashes? By the numbers, it was the largest single-day liquidation ever in crypto history. The 19 billion wipeout in hours towered over previous famous crashes. For perspective, the March 2020 Black Thursday crash triggered by the global COVID-19 panic saw about 1.2 billion in positions liquidated. The November 2022 meltdown during the FTX exchange collapse was around 1.6 billion in liquidation. So what are the major gauge signaling now? First of all is the crypto fear and greed index. Just before the crash, the index was above 60. Within 24 hours, it plunged to around 24. However, notably, it did not stay at rock bottom for long. By the start of the next week, fear and greed had rebounded to the mid-30s, and by October 14, it was about 42 on the cusp of neutral sentiment. This may suggest that the market views the crash as a short-term event or manipulation rather than a fundamental collapse. As for price recovery and key levels, another gauge is how quickly price recovers and hold key support levels. In this case, Bitcoin's ability to hold the psychological important 100,000 level is very much critical. Okay. So the fact that Bitcoin quickly bounced back over 110,000 is viewed as a positive signal. As for market breadth and leadership, examining which coin rebounded strongly can be telling. During the crash, Bitcoin and Ethereum showed notable resilience. Bitcoin had the smallest percentage drop among top assets and quickly recovered a lot of ground, which Ethereum actually ended the crash higher than it started. Wow. Okay, while Ethereum, not which, sorry. This implies that investors fled to the relative safety of the largest, most established coins during the turmoil. Smaller altcoins and meme coins had larger drawdowns and less complete recoveries. This divergence indicates a flight to quality. Blue chip cryptos are leading the recovery, which is typically what one wants to see for a healthy market. As for on-chain and derivative metrics, the crash naturally caused a huge flush out of open interest, which is actually a reset of leverage in the system. Funding rates briefly went very negative for Bitcoin and other coins during the plunge as short sellers pile on, but normalize after. A high negative funding rate can signal a short-term bottom as too many people are short. Exchange balance data showed that some investors sent coins to exchange during the panic, likely to sell, but then large outflows followed as strong holders bought the dip and moved coins back to the cold storage. And that was the main point. That's why you say large outflows, and this is a good thing. All right. So signs when a crypto winter could be starting. Now, this why I purposely want to put this thing here. Now, even though everything looks rosy so far, we still need to be careful and be alert because we are at the tail end of the halving cycle already, where traditionally, if you've been following the halving, monitoring them the points, this is usually the time when you will see a push down, winter arriving with prices dropping. So what are the signs? Now, there are a few key signs analysts watch for which could indicate the bull cycle has truly flipped to a bear cycle. First of all is the key levels. 100,000 as a crucial support floor. Falling below it would likely attract more sellers and a warning that a crypto winter could be unfolding. Second is the sustained fear and capitulation signs. If we start to see multiple week periods where fear and greed index is stuck in, say, the 10 to 30 range with no rebound to neutral, that suggests the market has lost confidence. Another sign is if trading volumes dry up significantly, that can indicate that retail interest has waned and only die-hard remains. Okay. As for macro and market headwinds, continue. Signs here would include a resurgence of inflation forcing central banks to stay hawkish, a significant economic recession reducing investors' appetite for speculative assets, or escalation of global conflicts, trade wars that make investors flee to safety. Now, in late 2025, there's an expectation that the US Fed will start cutting rates soon. If that expectation is proven wrong and instead they keep tightening or hold high rates due to sticky inflation, it could dampen crypto for a long stretch. Now, there are also part where we have good news being ignored. If over the next months, we get normally bullish developments, for instance, a big tech firm integrating crypto, and yet prices continue to stagnate or drop, that would imply market is in a bearish grip. Okay, I give you an example. Let's say Amazon says they're going to accept crypto right now, or they're going to buy crypto. That's a big thing, right? But still, that news is not enough to push crypto higher. Just be careful. Now, here are the points why this might just be a flush out and how Bitcoin could still hit new highs. Flush out here means normalizing because the market is too skewed to one side. So this is basically clearing, resetting things to zero. Now, here are the key reasons and signs supporting this optimistic outlook. Now, rapid recovery and V-shaped rebound. The speed which the market found a floor and bounce suggests inherent strength. Within hours of the cascade, okay, buyers stepped in aggressively. Bitcoin's wick down to 102K was bought up to 110K the same day. Okay. So V-shaped recoveries are more characteristics of bull market corrections than of bear markets. In a true bear, bounces are often weak and short-lived. The fact that prices did not continue sliding after the initial crash and even rallied 10% off the lows indicate that there's still strong demand and liquidity ready to enter the market on dips. As for leverage cleansing, as noted, about 19 billion of leverage got wiped out. While painful for those liquidated, this can actually reset the market in a healthier state. Excessive leverage tends to make the market fragile. Once it's flush, the remaining market is more organically driven by actual spot demand. Okay? So usually when the market go up, when you want to study fundamentals, we don't look at the leverage that is pushing prices up. The more the leverage is, then that's not a good thing. Okay, so a good and healthy rising market is always supported by spot, not leverage. As for institutional and long-term holder confidence, there are signs that big players remain bullish and even use this dip to accumulate. For example, MicroStrategy reportedly added 220 Bitcoins to its holding around this time, even though their buying was slightly before the crash. Now, JP Morgan announced a 1.5 trillion US investment initiative around emerging technologies, AI, blockchain, etc., which signals that major financial institutions are positioning for a future where crypto tech plays a role. And notably, BlackRock CEO Larry Fink gave a very bullish statement on national TV around this time, comparing crypto to digital gold and saying it has a place in investors' portfolio, a stark contrast to his skepticism years ago. As for macro factors turning favorable, now as 2025 closes, the market anticipates a policy pivot towards easing. In fact, the US Fed already cut rates in September 2025 and is expected to cut further in coming months. Historically, Bitcoin has thrived in environments of monetary easing. If indeed the Fed carries out a series of rate cuts, say 2 more rate reductions over 2025, it would likely inject liquidity and rise appetite back into the markets, including crypto. Of course, this assumes inflation remains in check. So, as a conclusion, several factors suggest that October crash was a brutal but contained event. The market's swift rebound, the purge of leverage, continued institutional accumulation, favorable shifting macro winds, and upcoming catalysts all support the case that crypto can recover and possibly soar to new all-time highs in the coming months. If Bitcoin holds critical support and external conditions improve, example rate cuts, trade peace, this dip could very well be remembered as a temporary bear trap on the way to higher prices. As one analyst quipped, the 19 billion liquidation was a gift to those who had dry powder, aka money, resetting valuations just in time for the year-end and pre-halving run-up. So only time will tell. For now, cautiously optimistic seems to describe the mood. Okay, so I'd like to reiterate, you have to be cautiously optimistic. Okay, cannot just go full on. The worst may be over and a healthier market could emerge from this historic crash, potentially setting the stage for the next chapter of the crypto bull run. Okay, so this is for 2025. When it comes to 2026, I think we need to re-evaluate this and let's see then. With that, that's the report for today.